Hi, this is Ken Boyd with the Accounting Accidentally website. You'll find links to over 300 blog posts, and if you scroll down to the middle of the page, you'll see links to over 400 accounting videos. This is part 2 of a discussion on using the effective interest rate method to account for the discount on a bond purchase. So in this case, the buyers purchase a bond for less than the face amount, the amount stated on the certificate. And I had in the first video set up this discussion, and we start off with a carrying value of $377,107. So let's say that's what the investor paid for the bond, and at maturity they're going to get back $500,000. Now that's a gain, the difference between those two numbers, and the effective interest rate method helps us recognize that gain in income. So the investor is going to receive $500,000 times 6% or $30,000 consistently each year. That's stated also in the certificate. But we have a term here called purchase to yield, and you'll see this in test questions. In this case, the bond was purchased to yield 10%. So yield to maturity is the total return on the bond, meaning that if you take the 6% earned every year in interest and you consider the gain, we're going to say that's an annualized yield to maturity of 10%. So how do we calculate this bond amortization? So first of all, we take the carrying value in blue times 10%, 0.1, and we get 37,701, which is more than the interest rate. So the difference between those two numbers, B minus A, is the amount of the discount that we amortize. You can see that the amortization decreases after year 1 and every year until it's all used up. And you'll also see that the carrying value increases. The carrying value increases until it increases all the way up to $500,000. So at the end, with rounding, you have no unamortized discount, and you have a $500,000 carrying value at maturity, which in this case is 10 years. So if you slide down, you can see the journal entries that are made here. When the investor buys the bond, quote, purchase to yield 10%, on the investor's books, we create an asset account called bond investment for the entire face amount of $500,000. We post the discount, the unamortized portion of $122,893, which agrees to the number right here. And then the cash that we pay, the $377,107, that's the carrying value that you saw up above. And then each year, as we amortize, we debit an account called discount for bond amortization. There's the 7711 from up here with rounding. And we move that into income because we're earning additional income as an investor because of the difference between the discount and what we get at face value, what we get at maturity at face value. So if you think about a T account over time, gradually the bond discount is going to be debited down to zero, and all of that discount amount is going to be posted to income. I'd like to also remind you here at the end that you can go to this account, this link, and get to the conference room feed, which is the online community for accounting. And if you click on courses, you'll see that we have 3 courses at this point that students can take, and you'll soon see instructions on how you can attend live courses. Thanks very much for watching, and we'll see you next time.